All right, the big thing now, of course, is QIPs, or Qualified Institutional Placements, or placements with institutions. Jagannadham is equity head at SMC Capital. He joins us right now, and he's prepared a small document on this. Jagannadham, tell us the key points that you have in this document.
Yeah, it's like this, and we have tracked the markets of IPOs, rights issues, and the QIPs in the first 5 months of 2008 versus first 5 months of 2009. Out of the first 5 months, January, February, March, these 3 months of 2008 were much higher than the first 3 months of 2009. This was the time when 2008 had Reliance Power IPO and the SBI rights issue. Come April and May, already in 2008, the bearish trend was setting in and the fundraising has dipped. Whereas in case of 2009, April, May, the recovery has started. So April, May 2009 has 5 times more than the 2008 April, May fundraising. So essentially speaking, the lines have crossed. And April and May of 2009 essentially featured with the QIPs, not the IPOs or the rights issues.
But Jagannadham, there have been almost cats and dogs have been applying for QIPs. There is a whole bunch of companies, although the first 2 or 3, especially in the realty space, did very well in terms of QIPs. Do you think a fatigue factor has set in? Is there a resistance to buying the future QIPs?
Yeah, I mean, as you rightly said, in fact, QIP, the success of QIP was essentially because of its very less regulatory restrictions and very quick turnaround that can happen, because in case of a IPO or a FPO or any other fundraising mode, it won't take no less than 4 to 5 months. Whereas in case of a QIP, everything can be wrapped up in a matter of 4 to 5 days. So that was the main theme why QIPs have such a robust performance in the last 45 days to 50 days. Because last 45 days to 50 days, even the capital market has went up by 90%. So naturally, the corporates and the investors were looking what is the easiest and the quick way to cash in upon this secondary market revival. So the obvious answer was QIP, because naturally everything can be wrapped in very short span of time, because there is no Sebi approval is required. And naturally, once the success of Unitech and India Bulls QIPs, naturally others also followed the suit.
Jagannadham, I just need to get a specific question, and if I may, could you tell us if we are missing something here on QIPs, which means are they really in the, I know they're equity instruments, but are they in the nature of debt instruments, and that's why institutions prefer them, which means there is some kind of a hidden buyback? 3 months ago, they could have bought these stocks for what the paper they were written on, and they didn't buy it, and now they all want to rush in. What is it that we are missing out here that creates the interest for this QIP?
So as I was telling, regulatory ease is one cause, and the second cause, Ashu, is in case of if somebody tries to go and buy in the open market, naturally the problem will be the impact cost. So that will end up in, for example, let's say Unitech or something, it was a QIP of about $325 million. So if somebody goes out and buy in the open market, naturally that may end up running up the cost and ending up to be impact cost. So naturally they have preferred a QIP route where they will get a guaranteed allotment. And in case of QIP, one more advantage when compared to a preferential allotment is that there is no lock-in. I mean, the natural answer question one more question that may come, why companies and the investors are choosing the QIP route, why not the preferential allotment? It's because in case of preferential allotment, there is a 1-year lock-in. And also in case of preferential allotment, the price at which the preferential allotment has to be done is average of 6 months, 2 weeks, whichever is higher.
Yeah.
Whereas in case of QIP, the pricing can happen at the average of the last 2
Point
weeks.
taken,
So the QIP pricing.
Yeah, got the point. Thanks a lot for joining us, Jagannadham, with your thoughts. Okay.